You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody, welcome back to Education Wednesday. Welcome back to the premier options educational program. Yes, welcome back to Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. I will be one of your Options Bootcamp drill instructors here on the program today. Glad to see so many of you are enjoying getting a lot of mileage out of the show. Like I mentioned last week, coming off the hottest, the busiest month in the history of the biz, at least for us. And we kind of are the options podcast biz. We started it back 15 years ago. So we have a little bit of a track record on this thing. So great to see so many folks are enjoying it. A lot of that coming through Options Bootcamp. A lot of folks want to learn about options these days. And who can blame you? These markets are crazy. So, of course, if you're listening on demand, as we know a lot of you are, if you like what you hear, keep those reviews coming. Just like our 5-star review this week comes from Michael. He says, I'm late to the options party, I think, but I'm on the train now. Thanks. 5 stars. Well, Michael, you know what they say, better late than never. And you know what? It's never too late to join the nonstop 24/7 options shindig, because it is certainly an interesting one to be on. And once you discover what these things can do and you realize, hey, wait a minute, I don't just have to ride the stock market up and then ride it right back down. There's a lot I could do in between there to improve my chances of being a successful trader. That's when you realize these options things are pretty cool. That's when you come over to the dark side. So thank you for that, Michael, and everybody else who takes the time to rate and review us on your platform of choice. Remember, if you want to go above and beyond, you want to get additional shows, you want to join anything we do throughout the week live, immediately ask questions, get your questions bumped to the top of the list. You know to go, theoptionsinsider.com/pro or /secret club. That also works, but don't tell anybody about that one. That one's a secret. Especially don't tell my other drill instructor here, Mr. Passarelli. He is not supposed to know about that. Dan, wipe that from your ears. You never heard about that secret club link, but what do you think about our buddy Michael and his 5 stars?
I know nothing. I think it's wonderful. There's nothing more that I like than 5 stars, except, 5.5 stars, but it's kind of hard to fit them.
Yes, now we demand 5.5 stars on every platform that goes up to 5. We demand you add on an extra half star.
That's right, exactly.
You write to Tim Cook, tell them to adjust their rating profiles and all the various other ones, Google and Spotify and all. Tell them all to adjust, and then maybe we'll be trendsetters, Dan. We will change the game for everybody out there. 5.5 stars, the first 5.5 star podcast, Options Bootcamp. As we keep rolling a little bit of the old options drills.
Well, in Boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to Options Drills. Like the man said, the portion of the show where we're going to go a little bit deeper into a particular options concept or strategy, or in this case, a Greek, and kind of explain how you could do some stuff, as we like to say, to improve your odds of being a successful trader in the long run. And Dan, last episode recently on the show here, we talked about some people's favorite, some people's least favorite Greek. That is theta, aka time decay. We talked about how to manage that going into and coming out of a long weekend. Very important right now. We're kind of in long weekend season with the addition of the Juneteenth holiday coming off the Memorial Day holiday. A lot of back-to-back long weekends. You don't see that too often out there. So an important one. If you missed that one, go back into the archives and check it out. This week, Dan, though, theta is a multifaceted beast, a hydra, if you will. Many heads always coming at you at once. So you have to learn. You chop one off, another one comes right back at you. So you have to learn multiple techniques, multiple tools to manage your theta. Dan, we already talked about managing your theta going into a long weekend. But what about it's middle of the week? What do I do then? How do I step in to control my theta outside of long weekends, sir?
Yes. So that is fortunately what a lot of people focus on. As we mentioned in the last episode, we want to focus on the more advanced parts of this whole thing too. But if you're not yet focusing on theta at all, holy cow, man, these two episodes are for you, man. You're going to love it. We always need to look at theta. Last episode, we talked a lot about theta and sort of how it relates to implied volatility and consequently vega. One thing that I'd like to talk about in this episode is how theta relates to delta. So I don't know, Mark, if you just want me to jump in, we can dim the lights, put a spotlight on, and I can have.
Go ahead. I got a beverage here. I'm all set. You can have at it, sir.
All right. So look. And this is good for everybody, but it's especially good for the newer folks out there, okay? If you're newer to trading, the trade that you probably make is you go and you buy some calls, right? Like that's typical because it's the easiest one to understand. It's typically the first one you learn. Hey, I think
my first options trade was a short iron condor swap. I don't know about you. I'm just throwing that out there. I'm just saying. Maybe I'm different.
I honestly don't remember what mine was, but I know it was delta neutral because my first option trade was literally on the CBOE trading floor.
Really? That was your first one?
Yeah.
I actually told the story about first one here. Obviously, it wasn't a short iron condor swap. I bought Microsoft calls. It was a one lot. And I blew the doors off it, and that just entranced me with options even further, sir. But I digress. Have at it.
Okay. So look. So if you have ever bought a call, if you've bought a call on 5 different trades, right? Like you probably started to figure something out, even if you never learned this. And that is, man, what the heck's going on? The stock's up a little bit and I'm down money. Why is that? Or, geez, the stock didn't really move, but the call's worth less. Why is that? Or the stock's down and, geez, my call's way down. And you start to figure out, you talk to people, you do some research, you read a book, whatever it takes, and you figure out, as time passes, options get worth less. And then you keep looking into it because with trading, the more you learn, the more you earn, right? So you keep your learning up. And you come across this thing called theta, which is a number like 0.06. And that means that as each one day passes, your option gets worth less by 6 cents. And you realize this eventually, but I'm just going to point it out to you so that you don't have to spend 6 months until it smacks you in the face like I could have had a V8 commercial, right? Is that like if you simply take theta and divide it by delta, what that tells you is how much the stock has to go up on average every day just to break even and cover your theta, right? And like, you might have to think about this math, like I listen to podcasts too. I do them when I'm running, so it's pretty hard to rewind them when I'm running. But if you got the little button where you can just push it and backs it up 10 or 15 seconds, you might want to do that here. Take your theta and divide it by your delta, and that'll tell you what the average, how much on average the stock must go up per day to make enough money on your delta to cover what you lose on your theta. And like, that ends up being a really profound thing, I think, for newer traders. Not only is it like, that's a nice little handy tool there, but like, that'll help you make the decision of what trade to get in. Because, if you're only looking at the stock going up by X amount over Y amount of time, then you better do that calculation and see, like, if I'm right, will I even make money? And, that sort of relates to everything we talked about on the last episode, where is implied volatility high or low, which consequently would mean is theta overpriced or underpriced. And, like all these things kind of start to take shape. And I just remember when I was learning options, it's just like, there were definitely plateaus that I would get to and then get to the next one and the next one. Every time I get to one of these plateaus, I have one of those epiphany moments like, oh, yeah, I get it, and hopefully if you haven't been following theta and looking at some of these things over the last 2 episodes we talked about, hopefully maybe you end up getting there with these 2 episodes. And that would be exciting for me and I imagine Mark too.
Yeah, obviously there's a couple of different ways you can approach it, but the primary way, the way we've counseled many times here on this network and on this show, we don't just say it to hear ourselves say it. The notion of you just buying straight up calls like Dan was talking about earlier. I mentioned my first ever options trade. That my one lot of Microsoft calls, it's great. You have all that long gamma. You make money when the market moves, but also gamma, theta, 2 sides of the same coin, right? So if you have a lot of gamma, you're going to have a lot of theta as well. So that's when people start realizing, wait a minute, if I'm not right, let's listen to some of our odd block segments on the option block, or listen to our options oddity show if you're on the pro side. How many times do we profile people coming in, loading up on massive 5,000, 10,000 lots of calls or puts, whatever the case may be, in the weeklies, giving themselves a couple of days for these trades to work out? And, normally you need only a couple of days to figure out if your options trade is working for you. You need to get the heck out of Dodge. But in this case, they're accelerating that process dramatically. So if you're worried about that, if you want to mitigate some of the impact of theta, how it can come back to bite your options positions, the only way to do it is to have some sort of other short leg against it. So you need to trade spreads, listeners. And these are going to typically be debit spreads. You have to actually pay for them. I know it's paying for it. It's people like credit spreads. Talking debit spreads here, though, today. And so that's really where the rubber meets the road for whatever you're buying. Let's say it's an at-the-money call in XYZ. You have to figure out where you're comfortable selling another option against it. It could be some people like, I know, Dan, you like the upside, the next upside resistance on the chart, and you use that to leg into the short leg of your now call vertical there. But wherever you decide to sell that leg, also you have to look at how much premium you're getting for it. Is it worth your while to really sell that, or is it you're just giving away your upside for a couple of cents? So you have to do that calculus as well. But that's the main reason, the main way to really mitigate the impact of long theta. You have to have some short leg against it. Dan, what are your thoughts on legging into debit spreads as a way to manage the impact of your theta, sir?
Yeah, now that is a powerful thing, and that's sort of like, not necessarily ninja tip, pro tip, but that's definitely a bigger tip than just like, hey, dude, freaking think of theta finally, right? Like this is, once you like recognize why theta can be a problem, this is one of the first tips on how to really manage it. And so there's really a couple of things here. Like, you can, I'm going to repeat a little bit of what Mark said and elaborate on it. Like, you can buy that call that you want to buy, but then sell the upside call. And like you said, I like to time that with resistance because, you make the assumption resistance holds. So you don't need upside above that strike. And what that does, of course, is since you're paying theta on the one you're buying and collecting theta on the one you're selling, but the one you're selling is further out of the money, it just makes your theta a lot smaller. Typically, like a typical ratio is that your delta might get smaller by like 40 to 60%, but your theta can get smaller by like 90 to 95%. So it makes it's sort of ironic, but between the strikes, it makes it a much more pure directional trade. It makes it more delta centric than theta centric. Now, that said, let's kick that up a notch, like Emerald used to say. He probably still says it, but I don't even know if he's still around. If you it depends where your strikes are. What our head coach, John Kamisic, who is just a really super smart guy and like the nicest, most likable guy ever, like all our students love him. And he's formerly the Goldman Sachs, so there's that too. What he likes to do is he likes to buy an in-the-money call and then sell an out-of-the-money call for his debit spreads, pretty equidistant. And when you do that, your theta can actually end up being zero. Because like a lot of people don't think about this, but your highest theta is at the money. If you go in or out of the money, your theta gets smaller either way. So if you buy in the money and selling out the money, like you could end up with a zero theta. And in fact, if the option you're selling is closer to the money, you can actually end up with a debit spread with positive theta. So like you've got like the Greeks, and in this case, we're really narrowing it on theta, like the Greeks enable you to just like fine tune the risk you want and the risk you want to remove with the precision of a surgeon. And it's just like you end up becoming a much better, more powerful trader when you employ some of these things.
People might be initially surprised when you suggest that, going to an in-the-money option. They say, wait a minute, am I not paying more for that in-the-money option? Is not my cost, my premium going up? And the answer is yes, listeners, you are. You're going to be in the money, so you're obviously buying a meatier option. There's more meat on the bone. But as Dan was alluding to, the at-the-money strike is always where the highest theta, the highest, most rapid decay is going to occur. So you get away from that, it's going to benefit you. Now, in this case, you're paying a little bit more for an option with a little bit more meat, so you have to have some actual intrinsic value. But the nice thing about that is that intrinsic value, guess what? It doesn't decay. That's always there. So as long as the underlying stays at that level, you will always have that intrinsic value. So that is immune. That is not subject to decay. So you are paying that. You're shelling out more for that. But that portion of the option is now not decaying. So you have an option could be a substantial portion of the premium you just bought is not subject to decay. So only a small portion is. And you're selling an out of the money option, which guess what? The whole thing, it's all about decay, nothing but decay. So that's how you could have a scenario where, yeah, you're paying a little bit more, but you could have an actually theta neutral, or as Dan mentioned, perhaps even, dare I say it, theta positive trade, which is an intriguing one. I like that, Dan. Maybe we'll have to explore that. So we'll kind of come up against it. I want to get some people with their questions on the show now, but it might be a good topic. Imagine now that we put that out there, we'll probably have some questions about structuring that. What do you think we come back to that on a future show, Dan? Positive theta debit spreads. What do you think?
Yeah, that sounds great. In some of our classes, I spend a lot of time on that and get into the synthetics of debits and credits, and it's interesting stuff. But hey, our classes are not just designed to be interesting and entertaining, but profitable. Like I said, the more you learn, the more you earn,
and also quite sexy, at least as the reviews say over there. Speaking of reviews, let's get to some of your comments and questions. It is time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to the mail call, the portion of the show where you guys take the reins, your questions, your comments, your insights, your pearls of wisdom. And people write in. We have a lot of people writing in questions. But if you're one of our pro members listening live, you get bumped to the top of the list, just like our friend here. Mr. Unlimited did today. Dan, we were just talking recently about blackouts, and you mentioned kind of the flooding of Chicago and how it shut down the exchange, all the electrical grid went offline. Mr. Unlimited wanted to know if there are to be brownouts and blackouts this summer, like some people are predicting, what does that do to the market? When some people can't trade or access what they own. I wasn't actively trading in the 2003 blackout, but I am curious if Dan or Mark remember trading in the August blackout of 2003. That was an interesting one. That was obviously the New York blackout that you're referring to, listeners there. And that one kind of interesting because the timing of it. As you recall, listeners, it was effectively mostly a late afternoon into evening blackout. So it kind of messed up the home rush there in New York and things like that. But the nice thing about that, obviously, the markets were pretty much closed. It happened a little while after the close. And it was also August. So it was kind of a slow time of year. So if you had to pick a time when you need to have a blackout after the close on an August slow summer day, it's probably one of the best days you could have it. Maybe you could argue right before Christmas maybe as well. But those are kind of the two periods where it could work out. And so we had the overnight session to really get things spinning up again. That's pretty much what happened. Most of the major brokerages were fine. The exchanges were managed to spin up and reopen by the next morning. There was a little bit of chaos in the bonds here in Chicago because obviously they trade on a little bit different hours. So the bonds are used to kind of doing their own thing. So that wasn't as disruptive as you might think. Now, fast forward to today, and you might say, what about ongoing blackouts this summer? The good thing about this, and I think one of the reasons why the 2003 blackout wasn't as severe, in addition to the timing, was we were coming off 9/11, right, a few years earlier. So 9/11 changed the game from a disaster preparedness perspective here in the financial markets. Everyone realized, hey, wait, it's kind of stupid to have a lot of our stuff right in downtown New York where, in the World Trade Center where things can get wiped out with a single terrorist attack. So pretty much in the next couple of years, it was a massive overhaul. Everybody moved a lot of their critical systems outside and had backups set up in outside areas. New Jersey and Chicago, it's out in the hinterlands out there. So there are now multiple redundant backups that could fire up at a moment's notice. So that's why 2003 also they were already in the process of building that out. Then the 2012, the Hurricane Sandy hit New York, and that really reemphasized the need for offsite backups and things and backup power and generators. And so these days, if a blackout were to roll through, it really wouldn't be as look at what we did just in the height of the pandemic. The exchanges were closed. It was all upstairs, and you could run that. A lot of that's run out of the Equinix data centers, in New Jersey and out here in the suburbs in Chicago. And I guarantee you, they have multiple upon multiple redundant arrays of backups. So those ones are pretty secure. So Dan, what are your thoughts on, if you have any, on trading through the August 2003 blackout and perhaps the potential these could pose? Because this gets back to what we were talking about before, right? The weekend risk. This could happen at any time. Well, what are your thoughts on the 2003 blackout and the potential for future ones impacting options traders?
Yeah, there's a couple of things. And, as some of the news is coming out, because we're recording this the day of the Fed announcement. And, I'm just kind of skimming a couple of the headlines while I'm waiting to jump in.
The Fed had a massive blackout. They're out of power.
Exactly. So I'm thinking about the parallel between supply chain issues, right? Because trading, just like buying a computer, the computer company is buying chips from here and, aluminum from here and something else from there and assembling them. And then they got to ship them to a store over there. And then you got to get to the store. And, all these things are, have been going wrong for the last couple of years. And that's what's driving inflation, really. But if you think about it, you've got that exact same thing with trading. You're sitting at your house, and when you send a trade, it goes to your broker, that goes to the Oprah feed, that goes to all the exchanges. And if the trade gets made, it goes to the clearinghouse, back to the exchange, back to the Oprah feed, back to the broker, back to you. Maybe there's some other hubs in there. I don't even know. But if your power goes out, you're not trading, right? Maybe you have a backup generator. If your broker's power goes out, they typically all, I'm pretty sure they all, at least all the big ones, have redundant servers somewhere, but it's probably one. Hopefully it's far enough away so that both don't get blacked out. But then, if the exchange has a blackout, there's that. And I do remember, I don't remember what the cause was. I don't think Chicago had rolling blackouts. Did they? Somebody can correct me if I'm wrong. I do remember certainly that there was at least 2 occasions when the power went out on the CBOE trading floor when I was trading. And I don't remember how long it was. Like memories fade and memories change, and you remember things differently sometimes than they were. But I know for sure that it happened. I want to say at least one of them was for like a fair amount of time, at least a half hour, an hour, or something like that. And then, there are other exchanges, but like there's a lot. If one of the major exchanges, because again, think about it, it's exchange groups these days, right? If one of the major exchange group server and redundant servers go out, the liquidity is going to go to heck. Like the markets are going to be a lot wider because it's fewer people providing liquidity. So yeah, that's it's really interesting to think about. And boy, I sure don't want to like go and try and look for problems where there are none and get everybody more worried than they need to be, because there's enough to worry about in this world today. But yeah, it's a thing that has happened before and will happen again.
Yeah, thankfully, it seems like there has been a lot of redundant steps to put in place we're certainly in a better spot than we were back in 9/11 or even 2003 when that happened the last time there, MU. So yeah, that should at least give you a little bit of ease. And the nice thing about it, Dan mentioned a couple of different scenarios. The most common scenario in that equation, right? Of course, you personally losing power. That's almost completely irrelevant to most traders now, right? Because a lot of them are using their mobile devices anyway. So your chances are your phone will still work as long as you have a battery backup or something. You have juice on it, and you will still have a cell connection. So, and probably data. So you probably, if you have a personal outage, you probably will still be able to access your own funds in some way. So at least that portion of the concern, I think we can mitigate there a little bit. We got a bunch of questions here. We're kind of running up against it. We have some questions of the week to pay off last week. Last week, we asked you on the show, Cboe just launched a new open outcry, just getting back to, of course, exchanges. They opened a new open outcry trading floor recently. So we asked you guys, does this still have a place in the modern options market, or is it an outdated relic of the past? And 45.3% of you, the savvy bunch listening to this show, said yes, it's still important. 30.2% said nope, electronic or bust. And 24.5% said what's open outcry? Okay, you folks need to start checking out some of the archives of this show, because we need to get you folks up to speed on what the modern options market looks like. All right, that music come to the end of another episode. Man, we just we burned through these, Dan. There's so much to talk about in so little time. We'll get to all you folks, GSP3 and Brian, on others on future episodes. A lot of you have questions about market selling off. We get it. We'll get to some of those selling questions you have and all the other fun stuff. If you have other questions, keep them coming. Remember, if you're on the pro side, you don't have to wait. You get bumped right to the top of the list. All right, Mr. Dan, before you begin your globe-trotting extravaganza, if folks want to reach out to you over there at MTM, where should they go? What should they do?
Well, folks, we are at markettaker.com, and I'm just going to throw this out there. This is something that I actually kind of went back and forth whether I should even say something on the show or not. But every year we have a mastermind event, and it's kind of invite only. So I'm kind of frankly not looking for 20 people to email me about this, but it's a thing where it's kind of invite only. We accept certain people who are pretty far along in their trading, pretty advanced, and would like to trade live with me and John and a very small handful of our other top traders. We accept up to 5 people per session, and there's only 2 sessions. And so if that fits you and that sounds like something you'd be interested in, and you feel like a true mastermind experience would be beneficial to you to get something out of it, and that you have things to share as well, you can feel free to hit me up, to email me, and we'll talk about it. We'll see if it's a good fit, and if it is, fantastic. And if not, that's totally okay too. But if you are really more advanced and you really want to get an experience like this, it's at the Chicago Board Options Exchange, which is a really cool venue. And we're going to do some really cool things while we're there, too. Have some special guests. We're going to twist Mark's arm to see if he'll come and show up to one or both of those sessions.
You got to pay my appearance fee, sir. It's pretty steep.
Exactly. We'll get you an Italian beef sandwich for coming, maybe.
Premium stuff.
Yeah. So you know where to find me. Dan at markettaker.com. You can email me personally if that's something you think might fit you.
There you go. Hit him up, Dan at markettaker.com, if you want to attend his creatively named mastermind. Dan, very nice of you to name those after me. You didn't really have to do that, but I appreciate the love you're sending out over there. We send love to all of you folks out there listening to this show. We love you all, whatever flavor you're getting in. If you want the legion of on-demand folks, again, all we ask, keep rating and reviewing so we can have more months like we just had, and more people can continue to discover the majesty and magic of options. You could argue more important than ever now that we're in a little bit of a down market. You need to learn to be a little bit more adept, a little bit more nimble out there. So we can help you do that. And of course, if you want to go above and beyond, theoptionsinsider.com/pro for all the fun stuff that we do throughout the week, all the exclusive stuff, and a whole bunch more. Stay safe out there, and we'll see you back here next week. Another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.